For more on this deal and the state of PE, let's bring in Pete Stavros, partner and global co-head of private equity at KKR. Pete, congrats on the deal. It's a top 3 deal for the firm ever. Also, for further validation of the employee ownership program, which you have been a longtime and early champion of. Of course, it also happens to be a service provider to an area that's skyrocketing, which is data centers. So I'm just curious kind of what you attribute the success of this deal to, and do you think it's repeatable?
Well, thanks for having me. We hit the right wave at the exact right time. So we bought the business in 2023. Obviously, data centers and AI have exploded since then. This is where everything's going. We worked with the management team to double the workforce, 10x the capacity. The earnings of the business went up tenfold. So this wasn't just a matter of multiples went up and we got lucky. Of course, we were fortunate. But it was great to see workers be fortunate as well. You know, when good things happen, the owners benefit, and here nearly 700 frontline folks got a chance to benefit as well.
In the PE industry right now, exits like these are rare all the time, any cycle, but exits in general are down. In terms of dollar value, they were up in 2025, but in terms of number, they were down about 9% last year. And I'm just curious how you found the exit environment when you were going through it with Cool IT. Do you feel like things are getting a little bit more unclogged, or is it still kind of the same bid-ask spread dynamic, the valuation, mismatch that we've been seeing over the past few years?
Well, this was unique. I mean, this was an absolute frenzy. We had 6 major companies dying to own it. Everyone was putting in phone calls to the firm, anyone that they knew, trying to get a leg up on the process. I would say more typically these days, the exit environment is not as robust. I mean, back in 21 and 22, when the market was really hot, if you had even a decent business, there'd be 6, 10 people who wanted to own it. Today, a lot of exit processes, there's a couple. So it's more of a buyer's market. Private equity's gone through a cycle in these last 5, 6 years. In 21 and 22, the private markets were on fire. And a lot of our peers overspent during that period of time. So there was at exactly when the 10-year was 1%, multiples were high, people overspent. That's created a bit of an overhang in the industry, and now it's the other side of the coin. There's not as much dry powder, not as much new money chasing deals. So it's an interesting time to deploy. Exits are a bit harder for the industry. Now, I do have to say, I expect this year to be an all-time record exit for a series of exits for KKR. Year to date we're only in March, we've already signed up 10 exits. We haven't announced the aggregate dollar value, but it's in the many billions. And I think this could be the greatest exit year we've ever had.
Exits in terms of dollar value or number or
dollar
both?
Value.
And is that just because of the vintage of the fund and because of the environment you think you can sell them into?
Yeah, so in that 21 and 22 period of time when our peers overspent, we had learned that lesson 4 fund cycles ago. So one of the great things about being KKR is you've been around 50 years. You've kind of seen everything. And the firm's good about learning from mistakes. So when we overspent prior to the Great Recession, we put in place a process where we would linearly deploy our funds. So if we raise $10 billion, we're going to deploy $2 billion a year for 5 years. That means when 21 and 22 happened and the market was on fire, our process required us to be constrained. And so we are not overweight the bad vintage years. We've more evenly deployed. We have that same bias on the exit. So once we've basically accomplished most of what we came to do with a company, we head for the exits.